our 900th episode.
Thank you so much for joining us today for this very special episode. This is the 900th episode of the show, 900 weeks. So if you do the simple math, that's just a little less than 17 and a half years. So for those listening, I want to give a special shout out for those of you that have been with us over those 17 years. Can you believe it? So thank you to each and every one of you. You are the reason that this show has been successful. Now on to our first story. I recently came across a CBS News column that looks at the impacts of poverty on older Americans, but in a different light. Typically, the media talks about the dollars and cents cost, but there's another cost, so let's dive into the column. For older Americans, the cost of poverty is 9 years of life, according to studies. Wealth has been long tied to longevity in the U.S. and other countries, but a new analysis is helping to quantify that gap between how low-income older Americans and their more affluent peers tend to live. And here is the sad truth. Low-income individuals over the age of 60 tend to die on an average of 9 years earlier than their high-income older counterparts. That according to a new study from the National Council on Aging and the University of Massachusetts Boston's Leading Age Center. About 15% of seniors with annual household incomes of roughly $60,000 died during the 4-year study period, compared with about 11% of those in households that had incomes of around $120,000. This is the first time we've tied health and wealth together. This was really shocking for me, said Jessica Johnston, Senior Director of the NCOA Center for Economic Well-Being, of the 9-year life gap. We traditionally and culturally were taught to value our elders, and if we played by the rules, we could age well. And I think that's changing. This study was conducted between the years 2018 and 2022 by the University of Michigan's Health and Retirement Study, and it tracks about 10,000 households in the U.S. So let's look at the breakdown between the median income, mortality rate, and the average age that one passes away at based on median income of that household. For example, those that make just a little over $19,000 a year had the highest mortality rate of 21%, passing away at an average age of 76. So for households that have an income above $60,000 a year, we can see that the mortality rate drops to 15, 13, and 11% respectively. And they live to an average age of 82, 83, and 85. So as we see the income and wealth gap widen, this is going to become an increasing concern. And I believe this is why a reverse mortgage is not only a financial lifeline, it could be a life extender or save someone's life literally from the stress of their finances, putting them in a position where they're going to pass away much earlier or have a chronic condition. All which brings us to the question, what are the underlying factors that connect one's median income to their mortality rate? CBS News notes that the difference in average mortality rate by income could be due to a lack of preventative care for low-income seniors or an inability to pay for their care as they age. Also, the stress of financial instability can lead to a premature death. Jessica Johnston, director of the NCOA Center for Economic Well-Being, said this: older adults are being placed into situations where they're going to have to make very difficult decisions. Am I going to go to the grocery store? Am I going to pay rent? Or am I going to get my medication? It's not about foregoing one of those things, but it's the added stress about those decisions. So consider this, the needs-based borrower has really been the cornerstone of HECM lending over several decades, and this may be the reason why. It says about 80% of those over the age of 60 have few or even zero financial assets and would struggle to cope with a financial shock, such as the loss of a spouse or needing long-term care, that according to the report. Most of those Americans will face financial insecurity in their latter years. Reverse mortgages are certainly not a cure for poverty. However, they may reduce financial stress, and that could help an older homeowner avoid having a chronic condition or dying prematurely. So when we talk about dollars and cents in reverse mortgages, we also want to discuss the impacts on one's health by no longer having the stress of being short every month. I think this really drives it home, this point in this study. You may want to discuss this with future potential borrowers. A recent column in Market Watch caught my attention, and for good reason. A 65-year-old son is considering if he should liquidate part or all of his 401k to help his mother pay off her reverse mortgage. The son wrote, "My mom has tapped out her reverse mortgage on her $1.5 million home. I want to help her by using my 401k. Will I get in trouble with the IRS?" There's one thing we can draw from this column, and it's that the reverse mortgage itself was not defective in any way. We have no idea why the homeowner, why the mother went through those reverse mortgage proceeds. We don't even know how much she got at the beginning. Maybe she's a spendthrift, or she had unexpected expenses, or is helping a family member. But nevertheless, she has access to no more funds on that $1.5 million home. He adds that we can sell the home, but the capital gains and real estate fees are horrible and will consume quite a bit of the remaining money. And it comes as no surprise that he is grappling with the capital gains ramifications, because the capital gains exclusions on the sale of a home have not been adjusted or increased since 1997. Presently, it's $250,000 exclusion for a single individual and up to $500,000 for a married couple. He asks, is it legal for him to take his required minimum distribution funds and refinance that $560,000 reverse mortgage balance and convert it into a traditional loan, even though it's in his mother's name? So we see that there are several factors that the son is really struggling to grapple with when it comes to if he should use part of his 401k funds to help pay off that reverse mortgage balance, and what would the tax ramifications be? What is the best route forward? My first question would be, is your mother living in the home? If you sell the home, where will your mother live? Says Deborah W. Ellis, certified financial planner at Ellis Wealth Planning. It's also important to understand that the lender doesn't own the house. In the event of a sale or death of the owner, the debt would be paid out of the proceeds of a sale, and the leftover or remaining equity would remain with your mother's estate. Based on the facts available, trying to construct a very complicated transaction to retain control of a property which is owned by someone else and already encumbered by a mortgage seems like a really bad idea for many reasons, said Jim Hempel, a CFP and managing director at GGS Financial. There are many strategies presented in this column, and one is a 1031 property exchange. My first suggestion would be to consider selling the property and rolling the money into a 1031 exchange, which would provide an income with no tax consequences until you sold the shares in that exchange. There are other siblings involved, and a significant amount of money is at stake, so I would tread lightly and consult with a financial planner, an estate attorney, and a tax attorney before moving forward. And a very good point is also made that a typical reverse mortgage line of credit typically grows each year, so it's important to determine whether or not that credit line has been truly exhausted. So here are a few key takeaways from this story. First is that the reverse mortgage likely did its job and that it helped her meet unexpected expenses or pay off bills. But there's another consideration, of course, that we just discussed, and that's that the IRS doesn't care why you're using a large withdrawal from your 401k or qualified retirement account. It's still going to be taxed as ordinary income, which could push her son into a higher marginal tax bracket. Generosity doesn't have a deduction, unfortunately. A recent CBS News column examines something that most homeowners are completely unaware of, and yes, even some reverse mortgage professionals, and that is a single-purpose reverse mortgage. The column notes that today most homeowners have over $300,000 in home equity, which they could tap into. and many seniors even have more than that. But while tapping into home equity could be an affordable way to borrow money, today's high rates may make that payment unaffordable, and the amount of equity doesn't always translate into easy access to cash for those living on a fixed income. However, reverse mortgages could be one way to bridge that gap. Of course, the most common is the home equity conversion mortgage, or HECM, but there's a lesser known reverse mortgage. That is the single purpose reverse mortgage. The program isn't widely known, the column notes, but it can offer targeted or very specific financial help at a lower cost of closing. A single purpose reverse mortgage allows a senior homeowner 62 and older to borrow against their home's equity, but only for one specific pre-approved purpose. And as CBS News explains, that could be something such as paying overdue property taxes, making critical home repairs, or improving energy efficiency, and even covering homeowners' insurance. Another major difference with the single-purpose reverse mortgage is that these loans are typically offered by state or local housing agencies, not by large banks or lenders. And because they're not federally insured like a HECM, the terms can vary widely based on the program. Historically, the single-purpose reverse mortgage has been designed and targeted toward the lower-income homeowner who may have to make significant repairs to keep their home livable and safe, or for those that are most likely overdue on their property taxes, which is an increasing problem amongst older homeowners across the nation. Here's the real rub with a single-purpose reverse mortgage and what many older homeowners need to consider first, and that is, will I need more money in the future? Such as Margaret, she had a $3,800 tax bill. What if she falls behind again in the future? She's not going to qualify for another single-purpose reverse mortgage program. So likely she would need to get a traditional reverse mortgage if she has adequate equity remaining in the property. It's noted that like a traditional reverse mortgage, the loan balance plus any interest or fees, if they do charge them, comes due when the homeowner sells the property, moves out, or passes away. The process is straightforward. You have application and approval with the local agency. They determine the loan amount based on the need, and that could require a quote from a contractor or the actual property tax bill that's overdue. And unlike a reverse mortgage, the funds never will hit the checking account of the homeowner. It says rather than receiving a lump sum to use freely, those funds are typically paid directly to the service provider or to the taxing authority. There are income qualifications. Many programs have income caps to ensure that the loan will benefit those that are most in need, and homeowners with higher incomes may not qualify even if they do have substantial housing costs. While single-purpose reverse mortgages are helpful for select homeowners who only have a one-time need for funds for a specific purpose, such as property taxes or making a significant repair or improvement to their home, I believe, and I think this is the experience of many of you watching, that is not the case for most elderly or older homeowners. Their need for additional cash flow or to pay unexpected expenses continues on far into the future.